flying pretty close to the ground. You're not very far from a recession, right? So in Europe, we're expecting growth of about 0.5% this year, and it's not going to be very different next year, right? So we're looking for growth at 0.6%. So in real terms, growth doesn't change that much. Remember, Germany was extremely weak this year, particularly the domestic part of the economy was also weak, which was quite a surprise because the external part of the economy being weak, you can understand. Global trade has been weak, China has been weak, investment has been weak. But you're also extremely weak in the domestic part of the economy, despite the fact that the consumer does have jobs, the consumer does have savings. So there's a little bit of a rebound in the domestic economy, whereas the external economy, the trading economy, the manufacturing economy remains weak. I think the big call is not just the real growth, it's actually earnings, which is different, right? Because nominal GDP will be dropping much more than real GDP would be changing. So the delta in real GDP could be close to zero. But the delta in nominal GDP, which is what matters for earnings, is going to be that much more higher. So it's going to be perhaps about 2 to 3 percentage points delta, which means decline in nominal GDP. And that's going to mean that earnings, despite the fact that you're likely not going to go into a recession next year, unlike the US, we think the US is going to go into a mild recession. Although you're not going to go into a mild recession in Europe, you are probably going to see negative earnings growth.
So an earnings recession in Europe, even if
Indeed.
we don't get a macro recession. So we're not bumping along the bottom then yet, Bhanu, by the sounds of things. It sounds as if you think we have further to fall in Europe on the growth story.
On the nominal growth story, absolutely. In the real growth story, I think we are bumping along the bottom. In the market story, absolutely not. In the market story, I think we have further to decline, both because earnings are going to come down and also because the cost of capital is likely to go up, which I think many people take a double take on because we think ECB is going to be cutting rates. The market's already pricing quite a lot. So how is it that the cost of capital is going up? Because the cost of capital or the discount rate is not just the risk-free rate, it's the risk-free rate and the risk premium. And the surprising thing about 2023, there's a lot about 2023 that you probably want to leave in 2023 and not extrapolate into 2024, which is that risk premia atypically are very, very tight. Atypically for this stage of the cycle, for how much we have seen interest rates increase, risk premium, I mean, look at where VIX is trading, look at where European high yield is trading. So most measures of risk premium are extraordinarily tight. So what's likely to happen next year, we think, not just in Europe, but across the board, is that risk-free rates are likely to come down, i.e. central banks are going to cut rates. BOJ is an exception, but most of the central banks are going to cut rates. But risk premium are likely to widen, and therefore the cost of equity actually goes up. So you don't get a valuations tailwind despite the fact, at least in the beginning of the year, in the first half of the year, you don't get a valuations tailwind despite the fact that central banks are actually cutting rates.
Okay.